Good morning. We are initiating coverage on Broadcom Inc., ticker AVGO, currently trading as a definitive bellwether in the semiconductor and infrastructure software sectors. Broadcom has effectively transformed from a pure-play component manufacturer into a diversified technology holding company. Our analysis today moves beyond the surface-level AI hype to scrutinize the structural integrity of their free cash flow generation, the integration metrics of the VMware acquisition, and their valuation relative to the PhilX Semiconductor Sector Index. We will dissect the company's dual-engine growth strategy, high-margin custom silicon for hyperscalers, and sticky recurring revenue from enterprise software. Let's look at the hard numbers. Broadcom operates on a unique aggregator model. Unlike peers chasing revenue growth at any cost, CEO Hock Tan prioritizes operating leverage. The core thesis rests on three pillars. First, the semiconductor solutions segment, driven by AI networking and custom accelerators. Second, the infrastructure software segment, now supercharged by VMware, aiming for 60+% EBITDA margins. And third, a capital allocation policy that aggressively returns cash to shareholders while servicing the debt load incurred from M&A activities. We project Broadcom to maintain adjusted EBITDA margins significantly above the industry average, effectively operating as a private equity firm in public clothing.
Let's drill down into the hardware. Broadcom's moat isn't just in general compute, it is in connectivity. The AI clusters deployed by hyperscalers require massive bandwidth. Broadcom's Tomahawk 5 and Jericho 3 AI switch chips are the backbone of these clusters. Furthermore, their custom silicon unit, ASICs, is designing specific AI accelerators for major clients like Google and Meta. While NVIDIA dominates the GPU market, Broadcom dominates the packleys that allow those GPUs to communicate. We forecast semiconductor revenue CAGR to remain in the double digits, specifically driven by a 30% year-over-year increase in AI-related revenue. The VMware acquisition is the pivot point for the bear-bull debate. Management is executing a textbook playbook, transitioning VMware from perpetual licenses to a subscription-based model. This creates annual recurring revenue, or ARR, visibility. We are seeing a rapid consolidation of SKUs and a focus on the relentless upselling of the VMware Cloud Foundation, VCF. Despite initial friction from customers regarding price hikes, the stickiness of the virtualization layer is undeniable. We model this segment contributing over 40% of total revenue within 24 months, with operating margins expanding as sales and marketing redundancies are eliminated. Financially, Broadcom is a cash flow engine. The company strictly adheres to the Rule of 40, but realistically, they often exceed a Rule of 60 when combining growth and margins. In the most recent trailing 12 months, free cash flow conversion rates have been exemplary. Note the divergence between GAAP and non-GAAP earnings. This is standard for acquisitive firms due to amortization of intangibles, but cash flow remains the source of truth. We are modeling SDF to reach nearly $60 billion annually by fiscal year 2026, assuming successful deleveraging and sustained AI demand. Valuation requires context. Broadcom typically trades at a discount to high-growth peers like NVIDIA or AMD due to its conglomerate discount and debt load. Currently trading at roughly 25 to 28 times forward earnings, AVGO offers a growth at a reasonable price, or GARP, proposition. If we look at EV to EBITDA, the multiple compresses significantly as the VMware synergies materialize. We argue that as software revenue mix increases, the market should re-rate Broadcom's multiple closer to pure-play software peers, potentially unlocking 15 to 20% multiple expansion. The bear argument often cites the balance sheet. Post-VMware, gross debt is substantial. However, institutional investors must analyze the interest coverage ratio and the maturity schedule. Broadcom has a history of rapid deleveraging post-acquisition. Management has committed to pausing large-scale M&A to focus on debt paydown, aiming to return to investment-grade credit metrics rapidly. The dividend remains safe and is expected to grow, but share buybacks may be tempered in the short term until leverage ratios normalize. In our bull case, Broadcom joins the trillion-dollar club. This scenario assumes three things. 1. The total addressable market for custom AI silicon expands faster than consensus, with Broadcom capturing 40% of the ASIC market. 2.
VMware retention rates remain above 90% despite pricing changes, cementing the software division as a cash cow. 3. The market awards a premium multiple of 30x earnings as the revenue mix shifts to 50. Conversely, the bear case cannot be ignored. The primary risk is customer concentration, specifically Apple, which historically accounts for a significant portion of revenue. Any rigorous analysis must account for the risk of Apple designing Broadcom out of the iPhone. Secondary risks include geopolitical tensions affecting the supply chain in Asia, and a potential enterprise spending slowdown impacting VMware renewals. If the AI capex bubble bursts or regulatory scrutiny forces a braze-out core fines, the multiple could contract to 15x, implying significant downside. In conclusion, we rate Broadcom as overweight. The risks are priced in, while the AI optionality is not fully appreciated in the context of their software margin expansion. Broadcom offers a defensive nature via its dividend and software recurring revenue, combined with the offensive capabilities of its AI semiconductor portfolio. We establish a 12-month price target based on a 26x multiple on FY26 estimated earnings. For the institutional portfolio, this is a core holding for exposure to the infrastructure of the digital economy.